Wow, this is honestly just crazy. Look, when I first saw the headlines crossing the wire for Hewlett Packard Enterprise's second quarter 2026 earnings, my initial reaction was literally just sheer shock. We are talking about a legacy tech giant here, a company that has been around in various forms for decades, suddenly posting numbers that look like they belong to some hypergrowth Silicon Valley startup. We're seeing record-breaking revenues, massive margin expansions, and a stock narrative that is completely shifting beneath our very feet. It's wild.
It is certainly a dramatic shift, but we aren't just going to read the headlines today. We are putting on our analyst hats to cut entirely through the market noise. Our core objective for this explainer is to uncover the real, raw data drivers behind this staggering financial performance. We need to answer what is actually causing this explosion in growth, and strictly based on the numbers, whether it is structurally sustainable for the long term.
Right, exactly. So here is our roadmap for today's analysis. We've got 4 stages. First, the HPE earnings shock. Second, peeling back the financials to see if the foundation is actually solid. Third, the AI networking moat. And finally, 3 future investment scenarios. Let's get right into it.
Moving into stage 1, the HPE earnings shock. The market is incredibly volatile right now, yet HPE is suddenly hitting financial targets 2 full years ahead of schedule. What is actually happening behind the curtain here?
The data shows that the primary trigger for this entire earnings shock is an absolutely massive 148.2% year-over-year surge in HPE's networking revenue. Now, we must interpret the meaning of that number. That is a structural shift, not just a temporary seasonal bump. Networking revenue hit $2.7 billion for the quarter alone. To put the scale of that performance into perspective compared to the past, campus and branch orders reached a new record high, growing in the upper 20% range, while data center networking shot up an incredible 233.3%. The numbers clearly dictate that enterprise demand is fundamentally accelerating.
Okay, wait a minute, doctor. How did they actually do that? What does a 148% jump in networking actually mean for our stock accounts? How does a legacy enterprise technology company just pull off explosive hypergrowth practically overnight? That's way too complicated. Could you give a simple analogy here?
Let me break this down for you into something much simpler. Think of HPE's core business model right now, specifically their GreenLake platform and their AI networking, as being both the digital landlord and the highway builder for corporate AI brains. GreenLake is their hybrid cloud platform. It acts as the digital landlord, providing the consumption-based property where companies run their data and applications. You only pay for the space you use. But an AI brain, like a massive, expensive cluster of NVIDIA GPUs, is completely useless if data cannot reach it instantly. HPE, supercharged by their integration of Juniper networks, is building the vital, ultra-high-speed infrastructure highways that connect the data directly to the AI. Without the highway, the AI brain essentially starves. It's proven by their business structure. HPE is providing both the property and the roads.
Okay, so what you just said basically means they are supplying both the critical roads and the real estate for the entire AI gold rush. Got it. That brings us to stage 2, peeling back the financials. Prove to me this isn't just a temporary accounting mirage.
The top-line growth is undeniable when we look strictly at the financial statements. Total revenue for the second quarter of 2026 came in at a record-breaking $10.7 billion. Comparing that directly to the $7.6 billion they posted in the exact same quarter last year, we are looking at a 40% year-over-year increase. This represents their highest ever second quarter revenue. The CEO, Antonio Neri, explicitly noted this performance puts them 2 full years ahead of their fiscal 2028 long-term financial plan. This data proves the demand environment isn't just recovering, it is accelerating aggressively, driven directly by enterprise customers who are heavily modernizing their infrastructure to scale out AI operations.
Breaking down that $10.7 billion figure shows us something even more vital about their structural health. We saw the networking segment jump to $2.7 billion, but look closely at the cloud and AI segment. It grew from roughly $6.27 billion to $7.7 billion. That is a 22.9% year-over-year increase. Furthermore, server revenue alone was $5.5 billion, up 32.7%. This proves that the growth is structurally broad-based across their entire next-generation portfolio. They are not reliant on a single product line. Customers aren't just buying the networking highway, they are heavily buying the servers and the storage that sit on the property too.
We also critically need to factor in corporate liquidity. HPE brought in $1.357 billion in raw cash proceeds during the quarter from the divestiture of the remaining 19% stake in H3C Technologies.
Over the course of completely exiting this joint venture, HPE has brought in a total pre-tax consideration of approximately $3.5 billion. In a macroeconomic environment where building AI infrastructure requires absolutely massive capital expenditure, having an extra $1.5 billion injected directly into the balance sheet is a definitive strategic advantage over competitors. It provides the necessary war chest to fund R&D and deeply integrate Juniper networks without being forced to take on toxic, high-interest debt. Okay, wait, hold on. They have record revenue and a huge cash injection, sure. But are they actually making money on this new gear, or are they just slashing prices to win market share? Because they are running huge operations, so why did the margins shift? What is the actual underlying profitability here?
That is precisely the right analytical question to ask. We track core profitability by looking at the gap between their GAAP and non-GAAP gross margins. The data shows GAAP gross margin came in at 36.5%, while non-GAAP was 36.9%. Both metrics are up massively, over 750 basis points from the prior year. The difference between the two largely comes down to the calculated costs of the Juniper acquisition, stock-based compensation, and the amortization of intangibles. The core takeaway from these numbers is that their operational discipline is fully holding up. They are executing ahead of schedule on their Juniper cost synergies, which directly translates to a highly profitable bottom line, not just empty revenue calories.
The ultimate, unassailable proof of that profitability is cash generation. You can manipulate certain earnings metrics, but you cannot easily manipulate free cash flow. For Q2, they generated $0.9 billion in free cash flow, which is an increase of $1.8 billion from the prior year. The management team logically defended these financials by officially raising their fiscal 2026 free cash flow guidance to at least $3.5 billion. When a corporate management team projects $3.5 billion in pure cash generation after all capital expenditures are accounted for, it clearly signals the underlying business engine is running at absolute peak efficiency.
So, what you just said basically means the cash flow is entirely real and highly profitable. Let's move to stage 3, the AI networking moat. In a totally brutal tech landscape, what is their irreplaceable weapon that competitors can't simply copy tomorrow?
The answer to that lies entirely in their strategic evolution and their elite partnerships, specifically their deep ties with NVIDIA. We are currently witnessing a massive industry megatrend where AI-native applications, things like retail personalization, predictive maintenance on large-scale manufacturing, or localized edge inference in healthcare, require predictable, ultra-low latency distributed infrastructure. The strict reality of physics means you cannot run these real-time AI applications in a distant centralized cloud. The data travel time simply takes way too long. You must bring the computing intelligence directly to where the data and the users actually live. HP recognized this fundamental shift early, and they are partnering deeply to scale this architecture out. Their true technological moat is what they call the HPE AI grid. If you look at traditional AI, it often relies on very fragmented, high-latency server clusters. It's disjointed and inefficient. But the HPE AI grid, which is built directly on NVIDIA's reference architecture, completely changes the game. HPE is fusing Juniper's telco-grade multi-cloud routing with their own HPE ProLiant compute systems and NVIDIA Blackwell GPUs. They are combining NVIDIA's raw, accelerated computing power with their own highly secure, zero-touch provisioning networks. This creates a seamless, end-to-end AI grid that turns thousands of distributed inference sites into one single intelligent system. That level of deep, hardware-to-software integration creates immense, sticky enterprise lock-in that competitors cannot easily disrupt.
Wait, stop for a second. What is the catch here? Look, no company is invincible. What are the actual risks to my portfolio?
Absolutely. And we must remain cold-headed about this. If we look strictly at their SEC filings, the data-backed execution risks are spelled out very clearly. Their fatal weaknesses hinge heavily on the Juniper integration execution. If they fail to realize the anticipated cost synergies, or if the corporate cultures violently clash, this massive acquisition suddenly becomes a heavy financial anchor. Furthermore, the data shows they remain highly vulnerable to macroeconomic headwinds and brutal supply chain dynamics. If the worldwide availability of key components, especially those precious NVIDIA GPUs, dries up, their entire AI grid rollout fundamentally stalls. These are real, tangible risks that must be weighed against the broader growth narrative.
Okay, so what you just said basically means the tech is revolutionary, but the execution has to be flawless. That leads us perfectly into stage 4, 3 future investment scenarios. Let's forecast the next few years based strictly on the data. We will sequence this forecast into 3 distinct paths based on current data models: a pessimistic bear case, a neutral base case, and an optimistic bull case. Each of these projected outcomes is entirely dependent on very specific operational and market triggers materializing over the next 12 to 24 months. Let's start with the bear case. The primary trigger here is a failure to properly integrate Juniper networks. In this pessimistic scenario, the exact execution risks we just discussed materialize. Supply chain dynamics falter, meaning they literally cannot get the components to build the AI grid. And macroeconomic headwinds significantly slow down overall enterprise IT spending. If the anticipated Juniper cost synergies collapse, those beautifully expanding gross margins we looked at will compress rapidly. The market will aggressively reprice HPE, downgrading them from a high multiple AI growth play right back down to a stagnant legacy hardware valuation.
The base case is the neutral, and arguably the most likely scenario supported by current corporate guidance. The trigger here is simply executing steadily on their stated numbers, achieving a fiscal 2026 non-GAAP EPS between $3.35 and $3.45, and reliably generating that targeted $3.5 billion in free cash flow. In this scenario, the Juniper integration proceeds smoothly, without major hiccups, and they utilize their strong cash generation to reach approximately 2x net leverage by the end of fiscal 2026. This represents stable, disciplined normalization. The market would view HPE as a reliable, highly profitable cash cow transitioning steadily into the AI era, supporting a very solid defensive valuation.
Finally, we have the bull case. The optimistic trigger here is the accelerated, widespread global deployment of the HPE AI grid. If enterprise customers and massive telco service providers rapidly adopt this single intelligent system powered by the NVIDIA partnership, HPE could hit or even exceed their highly aggressive fiscal 2027 framework. That specific framework calls for 8 to 12% top-line revenue growth, 12 to 16% EPS growth, and generating a massive $4.5 billion in free cash flow. If the data proves they can achieve this, the market will fully re-rate the stock as an indispensable, high-margin software and networking infrastructure utility for the entire global AI economy. To give our viewers a one-line summary of all this deep data, we really have to look to the legendary Benjamin Graham. He famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." That quote perfectly encapsulates HPE right now. In the short run, the stock bounces around based on AI hype, the voting machine of public sentiment, and these quarterly headline shocks. But in the long run, that weighing machine will strictly measure their actual execution, the successful integration of Juniper, the stickiness of their AI grid, and their ability to consistently generate billions in free cash flow. Which leaves us with our final, most provocative question. Will HPE's AI grid truly become the undeniable, irreplaceable backbone of the future enterprise, or will the massive integration risks of Juniper networks ultimately weigh them down? Thank you so much for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our channel, and they really help us keep diving deep into the data for you. So let me know what you think in the comments below. Are you a bull or a bear on HPE? Until next time, keep analyzing and stay focused.